Hello YouTube, welcome to another edition of Freyman CPA. Today we're going to talk about tax planning strategies. So I pulled up my ebook from 2014-2015 and this was Walter Kluwer, Tax Planning Strategies, CCH editorial staff publication. So it was actually really relevant when I first started out and was working in taxation. I've been looking at tax planning since day one, since I was basically, just starting to do tax returns for friends and family before we had a family practice, and we're servicing well over 200 individuals each year. I was already reading back in those days. I'd get on the subway and I'd get a deduction 101 book or something like that, and there was really no internet, and you kind of just read a book, a physical book, and that kind of kept me going. I was learning a lot on my way to and from work, and that was what was my passion. So when I picked up this book again, and it's a 2014-2015 edition, it's amazing how the concepts haven't changed, and a lot of the information is still relevant that's in here. I skimmed through it. I decided obviously I'm not going to cover the whole book with you guys. I'm just going to skim and just have it naturally flow from items that I'm cherry picking right out of the book. But yeah, I mean, the deductions might have changed. Some things have phased in and out of law, so some things are definitely not applicable. Rates have changed and so on and so forth. But the idea is still incredibly the same. So what is tax planning? And let's talk about the basics of tax planning. So in essence, tax planning really means setting up something a certain way so that it creates preferable tax situation for you. And that's very comprehensive when people come to us and they're asking, for example, for guidance. Should I start an LLC or an S Corp? And or I'm a W-2 employee. How do I maximize my taxes the most I can? Or I open up a business, how do I maximize? So those are very different situations because they're not exactly like tax planning per se. They're more about taking advantage of everything that you can that's on the table. If you think about our tax law and the tax system, I like to call it a you snooze, you lose tax system. And what does you snooze, you lose mean? It means that there's a lot of stuff on the table, and if you don't grab all of it, you just basically lose out. So great examples of that is like picking an entity type that's appropriate for your situation and getting the most tax benefits through that one way or another. And for example, if you're a business owner and you have health insurance, you should be putting it through business. If you have an auto, it should be structured properly and you should be putting it through a business. If you have an HSA account and you have a high deductible health plan, you should also be putting it through your business. So there's many different, but those aren't really like strategies, although people see them as strategies. They're more like really just grabbing everything on the table that's yours. And yes, they have to be put through a certain way, and there's absolutely ways of doing certain things. It's not like, it's just laissez-faire, let's do whatever and have it go through whichever way. So if you have an auto, there should be an accountable plan for your business. It should be going through a certain way through your business. You can't just automatically plop it in and start paying everything out of there. See our other videos that deal with auto deductions. But anyway, so let's jump into tax planning strategies. Now, when we're talking about deductions, I just want you to understand one thing. And we have a great saying here. We don't let the tail wag the tax dog. All right. It's very important to understand that we first do things for our own interests before we worry about the tax application. So in other words, if something convenes me and I'm going to go out and buy a car, I'm going to do it first for financial reasons, maybe personal reasons. For example, charity, maybe I'm personally charitably inclined. I do that for the goodness of the community, for religion, whatever. And then if it convenes my tax situation, then that's great. Then I'm gonna go ahead and buy that car or give that charity for good cause, because that's basically what drives me first and foremost, my financial, my personal reasons. And if it just happens to be if it just happens to convene the tax situation, then it's triple kudos, then great. So again, we don't let the tax tail wag the dog in our office. And the reason is, although a lot of people would like to say, well, don't you want to think of taxes? Well, in those cases, yeah, you do want to think of taxes, but if you're going to go out and spend $1 on a new car to save 30 cents in taxes, that's really, that's not a good financial decision, because you first have to see if this is what you really need, if it fits your finances, and then you'll worry if it saves you the 30 cents. So if it saves you the 30 cents, then great. But you first do it for, like I said, financial and personal reasons before you do it for the taxes. All right, so that's the premise here. The second thing to know is that tax laws constantly change, and you have to be ahead of the game to understand how it's going to change. So let's talk about tax planning and the importance of tax planning. And in a nutshell, in tax planning, when they speak about tax planning, they're really speaking about income and deductions primarily. So today I'll focus on income and the tax planning aspect. But when we're dealing with income, we can really just structure the income in so many different ways. But if it's income, it's income. All right, folks, so there's very little you can do with the income, so you can change your income around, right? So instead of getting W-2 income, you can be living primarily off of income that is tax exempt, or maybe it's taxed favorably, or maybe it's taxed at a low rate, or maybe it's deferred. So that's what we can do with income. Otherwise, unless it's specifically excluded from the tax code, gross income is all income unless specifically excluded by the tax code, and that's all income. Similarly with deductions, which we just touched upon, there's deductions and there's differences in deductions, and they all work differently as well, so we can structure them. But besides structuring the type of income and deductions you have, there's another very important key aspect to income and deductions, and that is the timing of it. So when we speak about timing, what we want to do is we want to basically structure the income into the lowest rates. So that can be many different ways. I can accelerate my income into a tax year that has lower rates. Basically, right now, we're in a very low tax environment. Right now, we like to joke around in the office and say we have a tax holiday. With the reform of 2018, if you're a business owner, you get a lot of tax breaks on your income, right? So it's a good time to be in business. Tomorrow, we might have a different tax law, and the rates will go up. So right now, just to give you some examples, if you're a business owner, and you're in the top marginal federal tax bracket, you're paying 37% at the top margin, all right? That's different from 39.6% where it was pre-2018. So this is the difference in tax rates. So if I was in 2017 in the 39.6 tax bracket, I would want to accelerate or rather decelerate my income into 2018 and beyond, because that's when the tax rates dropped. So at that particular time, I can actually make money on the spread just by timing my income differently. Same income, nothing's changed, it's still business income. I'm just pushing it from one year to the other if possible. Not always possible, but there's definitely ways that that's happened. For example, a good way of doing that, which we've seen in practice, and Angie knows this firsthand, is if you have, let's say, for example, your business in 2017, or if you want to be more 2020, if we say 2020, and you start a brand new business, here's your business, right? And you have a bunch of income that you received here, you can basically and let's say your expenses went into 2021, your business and your most of your deductions, for whatever reason, there's many reasons why the income and the deductions are just falling into 2 different years. So what you can do here is you can elect an accrual method of accounting. And push in the deductions to match the income, the old matching principle, accrual accounting, right? You're not, most taxpayers are cash basis. So that means that they get to claim their deductions when they actually have paid for it, right? And we'll jump into that a little bit more in a bit. But so cash basis, if I receive the income, in most cases, there's exceptions, but in most cases, when I've received my income and it's hit my bank account or it's readily available to me, then I have already received the benefit. Therefore, I'm a cash basis taxpayer and I'm already recognizing that income in 2020, but I've got a bunch of bills sitting on my table and I haven't paid them until February of 2021. Well, guess what? Since I'm a cash basis taxpayer, I won't get to deduct them and match them against my income, and it's going to create a big tax liability in this year and then have everything play out the next year, which who knows how that'll end up. So instead, one checkbox, if it's a brand new business situation, we say, oh, I'm going with the accrual method of accounting. I'm not going to be a cash basis. I'm going to match my revenues to my deductions in the time periods where everything was incurred, as opposed to when everything hit my bank account or was put on my account. So that's an example of how we accelerate, decelerate income. And just to give you an idea, and there's a lot of different tactics like that. But yes, that comes in with practice. But again, the premise is the same. Jumping back to when income and the lower rates, that's the basic premise of tax planning. Pay taxes paid at the lowest rates possible, either by doing it on different years or by looking at different types of income. Now, deductions works the opposite, as you can imagine. You want it at the greatest rates. So back to my 2017 example, going on to 2018, we've had people on December 31st, knowing that the rates were going to drop. So here you are at 39.6 on 2017 as the top marginal. And here it is on 2018. So if you went out and you bought a vehicle on December 31st in 2017 and it was in your possession and you're on the hook for that vehicle, you actually just deducted a vehicle at 39.6% as opposed to waiting one day later and getting it at 37%. So you're making money on the spread by just timing differences. So that's again, basic premise of tax planning. You want your income to be paid at the lowest rates and your deductions to be paid at the greatest rates. How you do that, that's a whole other question. Again, either by choosing different methods of accounting or waiting for the years to change and deferring the income and so on and so forth. But that's the basic idea. Are there specific strategies out there that can save somebody a lot of money by doing something strategically? Absolutely. We were just talking the other day when we were taking a multi-state course about how one company, this was done on a large scale company. It was actually very strategic because of all the various tax laws that come into multi-state. We were taking a course by a company that does a lot of large business accounting that have a lot of exposure, multi-state exposure. And what they did was they were able to save their client. This is an accounting firm that specializes in SALT, which is state and local use tax, state and local tax. And what they do is they're specialists in multi-state taxation because there's great variances and differences in all the different states. So sometimes a company could save a lot of money in taxes by doing something strategically. And this was a great example because they placed an employee into a different state strategically placed one employee in the state of Florida and changed around the whole entire map of how that company was set up, and that shifted the tides to such a degree that it was able to save their client over $1 million worth in state taxation. And that was done, so that's an example of strategic placement of certain, that doesn't work for everybody. That's like large companies. When you hear of large companies, setting up shop in some other foreign country to save on taxes, this is, a different scale of things. In small business, there's not as much of that as possible, but yes, there's still plenty of strategies that can be implemented that will apply to most people. All right, so that's the importance of tax planning and how it works using different rates. Obviously there's this also goes on, and like I said, just another great example of how this is still relevant. Filing status. For sometimes, every tax season we have people come to us, and one of their questions is like, hey, I'm married, should I do married filing separately? Is that going to save me money? Yeah, sometimes it does, folks. In very rare instances, you will be able to save money filing separately, but it's very rare. It's more common actually now than it was before. Before 2018, it was almost always a no. And then the reason it sometimes still might work out is differences in state tax law from federal tax law. But it gets very complicated very quickly, and the actual tax savings might not be worth all these additional returns that we have to create for our clients. So in other words, they'll be paying us a whole lot more in accounting fees than they'll actually be saving in taxes. So for the most part, it doesn't make sense. And when we're looking at different types of filing statuses when it comes to married jointly versus married separately, it's typically only done for liability purposes or keeping things separate purposes. That's the basics of it. So that's, yep, so I'm not going to touch upon AMT because that really doesn't affect most people anymore. They finally put a socket on that one. All right, so then this book goes on to talk about different types of income, and there's many different types of income here. It lists out income from profits of business, gains from dealing in property such as real estate or security. You have your interest income like bank accounts, CDs, loans, rents collected from real estate, real or personal property, dividends, royalties, alimony, child support, distribution from retirement plans, annuities and pensions, Social Security. So all of these are examples of different types of income, and these different types of income can all be taxed differently. But it goes on and talks about exclusions of income, right? So, and remember what I said, so everything is taxable income unless specifically excluded from the tax code. And excluded income would be, this is a great example, this is why I wanted to touch upon this, is the gain from the sale of a principal residence. So if you live in your home and you've lived in it for 2 out of 5 years, in most situations, you will not need to pay any capital gains tax, capital gains tax under Section 121 of the Internal Revenue Code. And that really deals with that particular exclusion. And if you're a single individual, or I believe married filing separately, you can exclude up to $250,000. If you're married filing jointly, it is currently $500,000 that you can exclude as a capital gain. Capital gain basically is something that they came up with, and they said that this is like when you're looking at you bought a home, right? It's a capital asset. It's your personal asset. Those are defined as capital assets. You made some improvements, and then you sold it. You take the home plus your improvements, and that's your cost in it. Whatever you received as a sale in terms of proceeds from the sale, you subtract the two numbers, and that's your taxable gain in a very simplistic type of manner, right? So you can exclude up to $250,000. Now this might be gone. I could remember this from my tax class in college. I was, this is probably like 2002, and my professor was saying there's somebody out there buying and selling homes all the time and just excluding their capital gains. And that's a great way to make money because real estate was constantly going up. And he went on to say, he was a really great college professor. I don't recall his name, but he was awesome. And he said that this is one of the last things that's tax-free out there. And he was right. And now we're not sure what they're looking at maybe doing away with this one. So folks, if you want to sell your home, this year's the year to do it, because I don't know what next year is going to bring or the year after. They might change it around. So this is where this book might no longer be relevant. And that's another example. Currently in 2021, it's still relevant. But 2 years from now, this might be a dinosaur, it might be gone, no longer exists, was a thing. And unfortunate, because it is your principal residence. And personally, I would imagine if they do tax it, then a loss might be deductible, because currently if you lose on the sale of your primary residence, there's no deduction for it. So you can't actually take any losses from capital, from that sort of thing, from capital transactions. Yep, so that's an example of something that's currently going on. And again, these things are open to change, but the idea so far is still the same. It doesn't matter if this comes in or out, the idea still became the same. Hurry up, if you were going to sell your house, do it now before the rates change, before the laws change. Same idea. All right, here's another example of excluded interest on savings, certain state and municipal bonds. So state munis, which stands for municipal bonds, that's tax exempt on a federal level. So if you live off of a lot of state municipal interest, then you don't pay tax. So that's a great way of setting stuff up. Interest on certain U.S. savings bonds. Returns of capital, obviously, if the idea is the same, if I put money into an annuity and the annuity is paying me money back out of the annuity, then part of it represents my initial investment, my capital, right? And the other part represents interest. And annuities are set up different ways. So sometimes they pay you right away the whole capital back, or part of it, or every payment can be principal and interest, or it can be structured so it's just principal, or it can be just structured as interest every time, and then eventually it converts. It does, so the annuities work in funny ways, but that's the idea. And the concept behind this is that you should not be double taxed. So capital in general is something that's already been taxed at some point or another. So somebody, for me to buy a house with cash, I had to earn that money somewhere. I already went out and I had a job and I paid federal income tax, maybe state tax, social security taxes. So I've already paid tax on that. And when I put it into a house or I put it into an annuity, what happens? It's already been taxed. So if I sell it or I'm retrieving that money back, I shouldn't be paying taxes on it again. Now in practicality, that's the way things really should work. But unfortunately, we see a lot of double taxation. Actually, we were talking about double, triple taxation here in Florida. We were talking about this the other day, where we have the tangible personal property tax. And that's for businesses, right? So in states where we have no income tax, we will see if you have a business and that business has assets, right? Like furniture, right? Equipment, maybe improvements. That stuff is subject to taxation if it reaches over 25K for this tangible property tax, tangible personal property tax. So what they do is they'll basically look at each business, and it's county specific. Not all counties have it, but most will. And they'll say, oh, well, wow, you have a business, you have assets worth more than $25,000. Let me start taxing everything that went over $25,000. And to me, that's personally a triple tax, because you first had to pay money to put that money into your business, or your business, as capital, or maybe your business earned it, and then you pay taxes on that money. So it was taxed once. Then to buy this stuff, you usually pay a sales tax. So that's twice. And then you're going to pay for it again if it's over 25,000 over. So that's 3 times. So that's a triple tax. That's how things work in reality. And then we have other examples of double tax is when people are working in different states and they're residents of 2 states. We call those statutory residents. And then the state that they're domiciled in will not necessarily give them a tax credit that's equal to the taxes that they're paying to the state where their source income is coming from. So in essence, it's a double tax. But that's a whole other story. And it goes on and on. So excluded income. So you want to either structure your income for exclusion, or you want to actually work with income that's taxed favorably. Here lists out Social Security benefits. Yeah, Social Security benefits is excluded if you have like 0 other income. Once you start getting mostly any other income, your Social Security benefits are going to be taxed. So timing your Social Security benefits is really important. If you're 65 years old and you're still working, maybe it's not the time to pull out your Social Security benefits, folks, because you're going to subject those Social Security benefits to taxation. And again, everything's relevant and things are subject to change. It also depends on maybe you're not working and you're collecting your Social Security benefits, but you have all this other retirement income. Your Social Security benefits are going to be taxed. That's when you move to an income tax-free state like Florida. Florida's a retirement-friendly state. And if you look it up, there's many retirement-friendly states. And that's another example of income tax planning. Whenever you look at people moving across state lines, especially now with COVID, people are fleeing like rats off a ship from New York. Why? Because of taxes and because there's no life there. So they just said, well, my business lets me work from wherever. I think I'm going to be smart. Now I'm going to move to Florida and call it my residence. Well, unfortunately, there's tax residency audits just for those kind of folks. And there's no such thing as a free lunch because New York's very aggressive when it comes to tax residences. So if you are doing something like that, you should still talk to a professional, understand what domicile is, understand what kind of ways there are to prove that you're changing your domicile, and not just go on a quickly move residences, because New York should be still sucking you back in for their tax purposes. Again, tax planning examples. We're not here to discuss every single part of tax planning because it would be a very long discussion. This book is very thick and it doesn't even touch upon all of it. There is just so many different things out there that we can go on and on and on and on. Oh, if you want to, here's another good example. Rents collected from real or personal property. Before I even go on, rents collected from rental. Right? So that's, you put up a house for rent. So if you're renting it for, what is it, Angie, 14 days or less, you don't have to report the income, but you don't get the deductions. So that's a way of structuring something to avoid income tax. As a matter of fact, if you have a business and we can then throw a party in the house, the rental, structure everything, document everything, but pay yourself rent for the fair market value and exclude that. So what happens? Your business gets the deduction. You're moving the cash from one pocket to the other pocket. This is a picture of a pocket. And here's the other pocket, which is still your pocket because this is your business and this is your personal pocket, right? So you just paid yourself rent to throw a company party for 13 days at whatever the fair market value is. You wrote it off your business and you just pocketed a bunch of tax-free money because it's specifically structured that way. That's called the Augusta rule. Something to do with golfing, I don't know. I'm not a golfer. Never was, never will be. Although I'm told I should be golfing because that's the way to meet rich people and that's how I'm supposed to rub elbows with those kind of folks. I think they'll just find me for my brains and looks and that's it. That's how I figure things are done. But yeah, that's basically the premise. So if I have a fancy shindig and I have a very expensive property somewhere that's worth a whole bunch of money, I can literally maybe transfer $10,000 for something like that, because if I were to throw a lavish party in a lavish kind of setup at some fancy lodge in some very nice area up in Colorado, that kind of rent bucks is $10,000 to $20,000 for a party of 20 people for my business or whatever. And I just saved myself at the, $20,000 times whatever my federal income tax rate is, what, 37%? Whoa, I just saved some money. And believe it or not, rich folks are the ones that love to save the most. That's a different story for another day. My uncle was very wealthy and he could really stretch a penny, and I learned a lot from him. But anyway, I didn't inherit any of that, so here I am working. All right, scholarships and fellowships, I'm not going to touch upon that. It's kind of ministers, this and that, Social Security benefits. Shifting income is a good one. If you have kids, or family members that aren't as well off as you are, you can hire them. If you need somebody to do the work anyway, might as well hire a family member. So the family member can, save some money. You can save some money by paying your family member, and combined as a family unit, you guys are saving money because they're in a 12% tax bracket and you're in the top marginal 37, and you still need the job done. The key is the job still has to be done. This is not just on paper type of thing where you're hiring your family member and they're really not working, like a child that's 6 years old. I think that's how that whole thing happened. Somewhere along the line, some smart aleck said, oh wow, I have a 6-year-old. Let me shift all this income over to him and call it a day. And then the IRS caught up to it and said, well, they didn't do any work, so you can't just shift income like that. And that's how a lot of other kind of things brought up, because the IRS comes up with rules and then somebody sits there really hard and thinks about how to go around those rules, and the IRS catches up and comes up with a rule against that. Sort of like the generation skipping tax. This is where somebody with lots of money, and there's not enough dollar signs to explain how much money that is, but says, well, there's transfer taxes. So if somebody's wealthy, wants to transfer to their son or daughter or whoever, next beneficiary, if they want to transfer the money over to them, there's a transfer tax on that. So what they would do is they would transfer it over to the grandkid. And then the IRS came around and said, no, because they figured that somebody's smart enough to figure that one out. And then they imposed the generation skipping transfer tax. And that's how they did it. So they didn't have to, Angie's smiling. She likes my presentation skills. And my drawings are just iconic. So that's an example of how that whole thing works. So again, shifting income is definitely a way to save. To postpone income. Well, I'm not going to go into incentive stock options because Angie knows that way better than I do. We talked about delaying collection. Deferred compensation doesn't pop up every now and then. We have it. People come in and they're like, oh, my company's offering me to defer my compensation. We go, great. Well, how would you like to get a huge bill in the year you're not working? Because that's what can happen. So you can be working here right now, and they say, well, let's see, you've earned $300,000, but let's defer it. Let's put it off, and here we are in 2020 into 2021, or 2022 even better. And here you are slightly older and a little poorer because you're not working and you couldn't find a job like this one. And here you are real happy thinking you're real smart. You got tons of money, you're spending left and right. But guess what? Not everything always pans out the way you could. And whoa, the rates just went up. We went from 37% to maybe 45. So now what happens? You're not working. You deferred it here, so you saved yourself on the 37% deferred compensation. You got the money, you earned it, but you're not holding on to it, and you get it all in the next year or 2 years down, whatever. And at that point, the rates jumped up. you're not working, all of a sudden you get this 300K, you have to pay taxes in that year. You deferred the compensation. You're going to pay taxes on it when you get it. Not always the best idea. It might work for some, it might not work for others. It varies. Annuities is a good way to actually also annuities. I think we touched upon it. So annuities are basically a great strategy for some people. You know, you're basically putting in money now, and they'll take a large payment like 100K or maybe 20K, something like that. And you put it into annuity, and it sits there, and then eventually it'll pay you money back. And like I said, when it pays you the money back, it does it in an income stream, and that income stream could first be all principal, and then principal and interest, or some sort of mix like that, where it's always principal and interest. So it really depends on how that's structured. Again, it's tax planning. Yes, you're deferring your income to some degree, I guess. I'm not sure why it's in here as, I guess you can, because it's here because you can transfer sometimes funds into it that would have been taxable. So a good example would be IRAs. So you can transfer your IRA into an annuity and basically get out of you know, paying taxes on those IRAs where they were sitting around for a while and you deferred the taxation a long time ago, right? So instead you said, well, and this happens sometimes, we see that when people are getting older and they've saved up a lot of money into their IRA account, and this was a pre-tax IRA. So literally like sitting on, let's say 500K worth of pre-tax IRAs, and they get to be a certain age, they're getting close to 70, or maybe they're already at 70, and what the government's going to start doing is they're going to say, well, you have to do a distribution. We're forcing you to start pulling out that money. You can't sit on that money forever. So they're going to force you to take this money out, and instead of having you take it out and start paying taxes on it now, what some people do is they'll move it over into an annuity. Now the problem with this is that, again, you're just deferring it. Two, you might be losing money on the financial end of it. So in other words, an annuity, it'll be like, let's say 6% when everybody is paying 12% interest rate. So you're better off maybe paying the tax and getting a higher return on your investment than moving it to a fixed annuity, and also not very clear what the situation is there. So that's a whole other world. That's not even mentioned here. They just basically talks about annuities, but that's just basic. This is basically like the gist of it. Let's see. Speaking of pre-tax and IRAs, this, everybody knows this. Put your money into a retirement account. Don't worry about it. Like-kind exchanges is probably going to also be a thing of the past. Although it's still written in this book, when this book was written, you could still do like-kind exchanges of different types of property, usually business property, right? So you have a truck for a truck from another business of like kind, rental property, right, for like kind. Used to be able to do this. Now this might be almost gone. We don't know what the laws are going to be like, but this is gone. This is no longer a thing. Although like-kind exchanges still exist. One of my favorite ones is installment sales. That's great for when you're selling a business. Installment sale. Works for both sides of the bargain. Again, you don't do things for tax reasons first. You do it if it fits your financial purposes first, then your moral purposes first, or your personal reasons first. Then you do it, because in an installment sale, so here you have a business and you want to sell the business for $2 million. What's going to happen? You're going to get smacked with a big, large tax bill in the year of sale, So if you're smart, you can say, oh, I have a great worker. That worker has been working with me for years. 20 years the guy's been breaking his back for me. I can definitely sell this business to him and structure an installment sale where he's going to pay me $200K for the next 10 years every year. So all of a sudden my tax bill decreased, because instead of paying taxes on $2 million, which would be at the top marginal, I'll be paying somewhere along the middle once a year, every single year for the next 10 years, and so on. So that's an installment sale. But you got to have the right person to do that. And if you don't have the right person to do that, somebody you definitely don't trust, all of this can go to mush. That person can drive the business into the ground, and it won't be any good, and then you won't have any money, and then all your opportunities gone because the business is now on the ground and you can't turn around and do much about it. So this is very heavily reliant on, again, does the situation fit? Are the circumstances correct for you to really use that strategy to your advantage? It's risky. It's risky. But they say without risk is no reward. This is still relevant. Look at that. Flexible spending accounts. Flexible. And we have a whole video on this one. FSAs. You know, if your work offers FSAs, use that. Defer the income through there. Because then the way it works, the mechanics, you can maximize your dependent care credit. Again, you have to be in the right bracket. You have to have the right amount of kids and everything. But if this strategy fits into many, I'll post a video on this towards the end. I did a whole segment just on this, exactly how it will apply to 2020 going forward. So this is 2021 going forward. I'm sorry, I believe it's 2021 and most likely going to go forward. We don't know exactly how yet, but 2021, this is a great year for this specific strategy, because it's going to be maximized compared to the way it always was. So that's very important, and it might stay relevant going into the future. So again, boom, great example. 2014, still relevant today, even more relevant than before because of all the craziness with the credits. So definitely look into that one, take advantage. All right, I think that's it for now, folks. I touched on income. Next one, we'll go over making your deductions count. I'm going to present you with a lot of different interesting. Angie's giving me the eyes of the you went over the 40 minutes line. I keep talking. She says I like the sound of my own voice. But remember, Freyman CPA all day, every day, making you a winner. Thank you very much and have a great day.